We will now begin today's webinar. This webinar is being recorded, and we will email you a link to the audio recording next week. My name is Sue Dalton, and I'm the Corporate Director of Sales for Goodwin House's Life Plan Communities, Goodwin House Alexandria and Goodwin House Bailey's Crossroads. It is my pleasure to introduce our moderator today, Lindsay Hutter, who is our Chief Strategy Officer and Marketing Officer of Goodwin House Incorporated. Lindsay?
Thank you, Sue, and welcome everyone. As COVID began to dramatically affect life as we know it, Goodwin House at Home and Goodwin House's 2 life plan communities moved quickly to provide health resources and information to older adults across Northern Virginia. In support of the stay-at-home proclamation issued by Governor Northam, we focused our efforts on hosting webinars, which can be viewed safely at home. Our first 3 webinars featured presentations from one of Goodwin House's medical directors, Dr. Maggie Gloria, and other Goodwin House leaders. Our goal was to provide information and guidance for physical and emotional health and wellness during the pandemic. In our 4th webinar, we are providing information on another type of health, financial health. In this moment of market decline and uncertainty, Goodwin House at Home and the Goodwin House Life Plan communities have invited 2 financial advisors to present on this topic: Taming the Bear, Worry Less, and Breathe More in today's market. Let's start with a few housekeeping notes. Throughout this presentation, you will see the PowerPoint slides and the presenter who is speaking on your screen. You may want to adjust the volume on your device if you're having trouble hearing us. To avoid background noise, everyone's microphone has been turned off. We have allowed 10 minutes for questions at the end of the webinar. You may submit questions during the webinar by entering your question in the chat box. You'll find that on the right side of your screen. We ask that you indicate if your question is for a specific presenter or for both. At the conclusion of today's webinar, we will invite you to complete a short survey. Your feedback will provide guidance on the value of today's topic and help inform future webinar topics and presenters. As we shift to the agenda slide, let me share our goal for this webinar. It is to provide a forum for timely information on the financial markets and financial planning. We seek to offer multiple perspectives from independent advisory firms, and to do so without endorsement. We'll first provide a brief update from Goodwin House, delivered by Karen Skeens, who leads our Continuing Care at Home program, Goodwin House at Home, and then you will hear from 2 financial advisors, Laurie Blackburn and Kelly Campbell. Following Laurie and Kelly's presentations, they will field your questions. It's now my pleasure to introduce Karen Skeens, Executive Director of Goodwin House at Home. Karen is among a select group of executives in senior living to lead a continuing care at home program. She has served as Goodwin House at Home Executive Director since Goodwin House launched this innovative program in 2014. It's my pleasure to now introduce Karen Skeens. Welcome, Karen.
Thank you, Lindsay. It is hard to believe how quickly our lives have been transformed in such a short period of time. Our country's efforts to stay safe and healthy are affecting nearly every daily routine in breathtaking ways. We are all facing this challenge together. Our goal today is to provide information that you will find helpful and useful as we move forward. Before I turn the mic back over to Lindsay, I want to tell you a little bit about how the Goodwin House Life Plan communities are supporting residents who live in one of our 2 communities, and how Goodwin House at Home is supporting members who are living in their homes just like you. Simply put, like many of you, Goodwin House residents and Goodwin House members are maintaining social distancing and taking recommended precautions to remain safe and healthy. They are interacting with family and friends using Zoom, FaceTime, and other online applications more than ever before. just like most of us are doing these days. In our 2 life plan communities, meals are being delivered to residents' apartments 3 times a day. Fitness classes, cultural programming, and presentations are made available on internal cable channels so residents can stay physically active and mentally engaged and sharp. Some residents have even taken their bridge games online, and others are enjoying cocktail hour using Zoom. For Goodwin House at Home members, their personal member services facilitator connects with them as often as they desire by phone, email, FaceTime, and other online applications. Members are being invited to virtual events like meet and greets, monthly luncheons, and will even offer a virtual concert soon. These are just a few of the ways we are staying connected to Goodwin House at Home members and ways they are engaging with us and each other during this stay home period in Virginia. We're offering a grocery program to members through Goodwin House so that they do not feel the need to risk going into grocery stores. Groceries are being delivered to their doorstep, and the cost of their groceries is simply being added to their monthly invoice. The benefits of being part of the Goodwin House family and not being alone at this time continue to evolve as needs are identified. Most importantly, members and residents know if they have questions or need assistance, Goodwin House is 1 telephone call away. Goodwin House at Home coordinates and pays for assistance with personal care for members who are in their home and need care at home. If one of our members is diagnosed with COVID-19 and needs care at home, we do have a contracted home care agency that can provide the care. Members and residents were proactive in planning for their future healthcare costs and needs by joining Goodwin House at Home or moving into one of our life plan communities. This means that they are not isolated, they're not alone, or at risk of being unable to access health care and home care at this time. Goodwin House at Home members and Goodwin House residents have removed some of the most significant concerns and risks older adults face today. Unpredictable future healthcare costs, access to quality care, and how to pay for that care. Members and residents also have the added peace of mind that Goodwin House and Goodwin House at Home will come to their aid night or day to be by their side every step of the way, every day, including during this unprecedented time. At the end of the webinar, we will provide you with information on how you can learn more about the services Goodwin House and Goodwin House at Home provide, so you too can secure your future healthcare needs and mitigate the risk of future healthcare costs and access to quality care. Thank you for joining us today, and we look forward to your feedback. Lindsay, back to you.
Thank you, Karen. I must say that when I see that wonderful photo of all those Goodwin House at Home members participating on that Zoom conference, I'm inclined to think that when the pandemic is over, we will have sort of flipped the technology learning curve. And instead of the grandchildren teaching the grandparents how to use technology, it'll be the grandparents and the aunts and uncles that are giving the lessons. So thank you very much for all you and the teams are doing to support our Goodwin House at Home members, our Life Plan community residents, and all those older adults that we care for across Northern Virginia. It's now my pleasure to introduce Laurie Blackburn, Senior Vice President of Investments with the Alexandria, Virginia-based financial advisory firm of Caudron Negary Blackburn Wealth Management Group of Wells Fargo Advisors. With over 20 years of experience in financial, investment, and retirement planning, Laurie focuses her practice on helping individuals and businesses develop, implement, and evaluate individual investment plans. She also advises local foundations and endowments on the management of their investment assets and investment policy. Originally from Kansas, Laurie received her Bachelor of Arts and Juris Doctor degrees at the University of Kansas. She practiced law for 6 years before moving to Alexandria in 1995 and transitioning into the financial services industry. Laurie's extensive community involvement includes serving as the current board chair for Senior Services of Alexandria and as a director on the boards of the Goodwin House Foundation and Westminster Presbyterian Church Foundation. Welcome, Laurie.
Thank you, Lindsay. I am really glad to have the opportunity to speak with you all today. And there's a lot to talk about. I think there's a lot of interest in, financial topics with everything that's going on in the economy and in the market. It's become, a cliche that we are living in unprecedented times. This is unprecedented events. You keep hearing that. And it's marked by uncertainty. And most of us don't like uncertainty. And markets don't like uncertainty. So there's a lot for people to worry about: their family's health, their health, the health of the economy, and the health of their personal finances. And it's all coming at the same time. So that makes it hard to sometimes make the kind of decisions you need to make. So I'd like to offer some perspective on that. So the first slide is what happened and how are we supposed to deal with that? The first quarter of this year was a shocking quarter in the market. There was a sudden and severe downturn. The Dow Jones had its most dismal first quarter in 135 years. So that was very surprising to people. But I am a history major and I still am a history buff. And I find that it always helps me to see things through the lens of history, to try to gain perspective on what's happened now. You often learn things. So even though this may seem unprecedented, this market feels unprecedented and it's not over yet. We may see worse things to come. In fact, I think it's likely we don't go up from here. But as of the end of the first quarter, it's only the 5th worst market drawdown in history. So that drawdown is from the top to the bottom. When it was at its low, there have been 4 other drawdowns that have been worse than this one. And over time, it's a short-term setback in a longer-term pattern of economic growth. So this slide is about the recession. You remember how awful and unprecedented the economy and the markets were around the Great Recession. And that had to do a lot with the financial system itself being rickety some of those times. With all fear and dread, though, this graph shows that going back to the 1930s, on a longer scale, the economy grows, and it's just a blip. Now, in the stock market, it's a slightly different story, just because, that's the next slide, just because stock market goes up and down more often than the economy. It's a little bit more jagged line, but the direction is the same. So even with ups and downs, and you see some identified on this graph, different wars, global financial crisis. I mean, at the time that felt cataclysmic, like nothing would ever be good again. And now it's just a big jagged edge on a graph. So the trend continues to be up. And in fact, in the 10+ year period after the Great Recession, that turned out to be the longest bull market in history. A bull market is when the market's going up. And at a time when people were very pessimistic, it turned out to be 10 years, a longer period of time than ever. And we remember those times fondly, but do you realize that there were 5 times in the last 10 years that the market experienced a drop of more than 10%? So we tend to not forget those when we see up markets. And that hazy recall of big drops, more than 10% drops, is an example of what we call recency bias, that we use our recent experiences as a baseline to predict what might happen in the future. But you need to know that bear markets are normal and expected. So bull market is an up market, bear market is a down market, and a bear market is achieved 10% as a correction, 20% minus 20% is a bear market. Okay, so but they are normal and they are expected. So you can see that about 3 times a year the market drops 5%, and about average of once a year the market drops 10%, and about every 3 to 6.3 years, the market experiences a 20% drop. So we had a very long period where we didn't have any significant long-term drops, and we kind of forget what that's like. So, the way a lot of advisors will work is when markets are up, we remind clients that they're going down. And then when markets are down, we remind them that markets are going up, that it's not the current experience is not going to be the permanent experience. Both up markets and down markets are both expected, and both can be planned for. Because if the brain's inclination is to focus on recency, then we have to work that much harder to impose a sense of discipline and focusing on the long term. So not only are bear markets normal and expected, you've seen a lot of them over the course of your lifetime. Just in your lifetime, there have been 12 bear markets since World War II. And that's a drop of more than 20%. So at the time, it feels unprecedented and cataclysmic, but you've seen this plenty of times before. So if you just take a look at it from that perspective, when you weigh everything in the balance, it's long-term thinking that's the key. It's discipline, consistency, planning, and long-term thinking where you get the real rewards. Because if you know something is going to happen and you plan ahead for it and you've thought about it more, then you tend to stick with the plan even when it feels awful and your statements look horrible. And in the long term, you increase your chance for success. More importantly, market timing doesn't work. This is my favorite slide because I just think it's really dramatic. For example, if you look at 2018, what that shows you is that for the year 2018, the market ended at -6%, but mid-year, it was at -20%. So if people panic when it was actually 19 point something, so it didn't quite qualify as a bear market, but for all intents and purposes, it was a pretty steep market decline. And if you had panicked when that decline happened, then by the end of the year, you would have lost a lot more money at mid-year than if you'd stayed till the end of the year. So being reactive to markets and reactive to things in general, that can result in costly mistakes. It results in attempts to time the stock market and participate when you feel like it's safe. And the next slide is why market timing really doesn't work. It's a perfectly normal reaction to think that you're just going to sell some of your assets invested in the equity markets till things settle down a bit. It feels safer. But unless you are an investment prodigy, especially gifted, when market turns are going to happen, it's a reaction that's very costly. So, for example, in this, you see that the average performance, if you miss the best days of the market, has a big difference. So this is from January 99 through December 2018. The average return, if you were fully invested, was 5.62. But if you missed just the 10 best days, that return was cut in half. And that's why we say market timing really doesn't work. If you missed the 30 best days in the year, you actually had a negative return. So unless you know exactly when the market's going to turn, it just doesn't work. And if that best trading day is your signal to get back into the market, then you've already missed out. What does work is just time and diversification. And that's easier to do when you have a plan. So what should you be doing? You should stick to your plan. And if you don't have a plan, you should get a plan. The key to solid investing truly is the discipline of a diversified portfolio over time. In the short term, there can be a lot of volatility, and we will continue to see a lot of volatility this year. But over the long term, just remember that those graphs smooth out. This approach isn't easy, and it goes against some of our brain's natural wiring. For example, there is a company called Dalbar, and they take a look at investor returns versus market returns. These numbers are really telling. So this is the average return of the S&P versus the annualized average return of the investor. So in 2018, when the S&P lost 4.4%, the average investor was down 9.4%. Over a 30-year period, the average stock investor has seen an annualized return of 4.1%, less than half of the S&P's 10%. And so how does this happen? The average investor fares poorly compared to the market because of the emotional reactions that lead to attempt market timing, trying to stay safe. And then it's so common that it's an entire field of study now called behavioral finance, because we do have some default reactions during a market cycle. When things are going well, we're excited to the point of euphoria, which is up at the top of the graph. It's thrilling to be part of the ride and seeing how much money you're making. But then our reaction gets more and more negative when the normal expected down markets occur. So anxiety, fear, panic, and despondency, and then capitulation. You hear people on TV talk about capitulation. That's when people just throw up their hands and say, I can't handle it anymore, I'm through. But in reality, we're reacting with euphoria at the time of maximum risk because the market has been up for a long time, and that means it's more at risk to go down. And we're reacting with despondency in times of maximum opportunity because the market's so far down. So it's a great opportunity to do investing at that time. So it's just counterproductive. And you can see this, I think this graph is really difficult to read, but if you just look at the colors, it makes a good point. You can see this by tracking the flow of money into mutual funds. During all those years of opportunity, when the market was down, people were shell-shocked from what happened to their portfolios in 2008, 2009. So for the first half of the bear market, they were still selling. That dark blue that you see is whether, if it's below the line, that's money coming out of equity mutual funds. If it's above the line, it's money going into equity mutual funds. So during all the times of maximum opportunity, people are selling. Then comes the really hot parts of the bull market. And after they've seen markets go up for year after year, then they're doing their buying. So after they achieved that feeling of safety, more than halfway through the bull market, people finally started investing in equity markets. And the more markets went up, the more they invested in equities. So I mentioned recency bias, and this is just a couple of other examples of how our brain kind of works against us and works against our attempts to have a disciplined approach to investing. You know, people who study this say that humans feel the pain of loss twice as much as they feel the joy of gain. So you're going to do more to avoid a loss, even if that's not in your best interest. I already talked about recency bias, that, you know, after 2008, 2009, many focused on defending themselves against another market free fall instead of seeking the opportunities that were in front of them. And then lastly, there's a herd mentality, thinking if everyone else is doing something, or if the TV tells me to do something, then all these people must know something that I don't. So it takes focused intention to work against your wiring in a way that can be most helpful for you. If you have a plan, it'll be easier. And I'll leave you with some wisdom from the Oracle from Omaha. When he was asked his secret to his investing success, he said he gets fearful when others are greedy and greedy when others are fearful. That is the oral version of what you saw in that graph, and that's why he has done so well. So I hope that this little look into history has helped get some perspective on what we're experiencing now. It may very well get worse before it gets better. And under the stress of everything we're worried about right now, it's easy to be reactive to fear. It's easy to be reactive to bad markets and forget all the things that we know about how things have gone over history. There's a lot we don't know, so we need to focus on what history teaches us and make the best, most disciplined possible decisions. So I wish you luck on all of that. Thanks very much for your time today.
Laurie, thank you. You have given us that wonderful gift of historical context, which allows us to take a deep breath, breathe more, worry less about today's bear market, and recognize the opportunities that may lie in today's bear market. I'm inclined to wonder if, along with that Bachelor of Arts degrees and Juris Doctor degree, that you might also have a history and psychology degree in there as well, because you delivered rich messaging and really rich guidance for us. And so we thank you for sharing your expertise with our audience today.
Thank you, Lindsay. Enjoyed it.
You're very welcome. It is now my pleasure to introduce Kelly Campbell. Kelly P. Campbell is the founder and CEO of Campbell Wealth Management, an Alexandria-based financial advisory firm. With over 28 years in financial advisory services, Kelly focuses on retirement planning for those age 55 plus. Nearly 15 years ago, he shifted the focus of his firm on retirement planning, restricting its clientele to those age 55 plus. The firm's advisory services focus on income and tax planning, investment management, legacy and intergenerational planning, risk management, and women's planning. Kelly graduated from the University of Maryland with a degree in finance. Kelly, Welcome.
Hey, I want to talk about a number of different things, but first I want to thank you all for being here, and love the quote that Laurie had brought on from the Oracle. It really is amazing, though, when you think about where the markets are and what kinds of things you should be thinking, but it's so hard to think that way. So, if he's saying be greedy when people are fearful, right? I mean, that's where people are right now. But if you're fearful, you're not able to take advantage of things. So that's why I entitled this making lemons or taking lemons and making lemonade. That's really the key, because if you can look at it that way, you'll see there's some great opportunities. So I want to share some of those things, as well as just some things you should be thinking about that may make this kind of this cycle we're in a little more palatable and a little more beneficial. So go ahead, if we can move on to the next slide. So it's kind of interesting. I love this slide, the plan A, plan B, and real life, because plan A is when we're putting things on paper. We say, hey, we're going to go from this position to that position. Kind of almost like your GPS, if you think of it that way. We know we want to get from point A to point B. We always have a, kind of a thought process or plan on how to get there. But oftentimes we have to have a plan B just in case. But then life comes in, and our plan A and plan B can be completely different. And that's where real life comes in. And especially what's gone over the last few months, it really makes it challenging. So I really want you to think about where we are. So I'm going to talk a little bit about the CARES Act, just so you kind of get where that's coming from and what's behind it. Talk about a little bit about capturing the upside and preserving on the downside. And then I'll talk about how to be opportunistic versus pessimistic and some of the things to think about from that standpoint. All right, so the CARES Act, $2.2 trillion stimulus package. It's actually, it's increased now, so there's a lot of pieces to it. But the basics are that pretty much everybody that had a tax return, filed a tax return last year, and even if not last year, they'll look back at 2018, is going to get a $1,200 check. And if you are claiming anyone on your tax return, you get another $500 check for dependents. The federal government has actually added to the state's program for unemployment. They're adding another $600 per person per week for an additional 4 months of unemployment. Now, they know that some people are going to make more money being unemployed than actually working. It is what it is. So don't worry about that. The government knows that's happening, but it's really hard to track these things when you're trying to help so many people, okay? Now, the other thing, though, is you can take money out of your 401k, you can take money out of your IRA, and do it without penalty. So if you're doing it before 59.5, typically there's a 10% penalty, but now they've waived the penalty, and they said basically you have a choice. So now if you take money out, and again, the only time I'd recommend this is if you really need the money. A lot of people, they may have some other options. If you have other options, use the other options. But if you do take money out of your 401k, out of your IRA, you actually have some time to either pay it back or you can actually pay the tax on it. It's your choice. And you have actually up to 3 years now to do that. So they've changed that plan a little bit, made it a little easier if you need money. Again, I'm trying to restrain from that because it really does. It takes from funds you're going to need later. If you take them now and use them, it may not be beneficial for later. Charitable contributions, they also said, remember, you had to actually file a Schedule A. You had to itemize deductions to be able to claim any charitable contributions that you made. And so what you can do now, they're actually allowing you to donate up to $300 per person. So if you're filing individual, it's $300 in that year without filing a Schedule A. And then if you're married, filing jointly, actually 2 times that amount, so $600 total. And then one thing they got rid of that a lot of people don't understand is they got rid of the 50% rule, which said if I donate to a charity, I can actually instead of only being able to donate up to 50% of my adjusted gross or being able to write that off, I can actually do up to 100% now. So they changed that as well. And then the last thing we all know now that they did change the tax return filing deadline from April 15th to July 15th. And then the other thing that's a big deal, especially for our clients, because we focus on retirement planning, you do not need to take a minimum required distribution for 2020, right? Now, they have suspended it. Doesn't mean you need to take 2 of them next year. It means they actually got rid of it. So that's a good thing. Also, if you have an inherited IRA, meaning if you got an IRA that wasn't from your spouse, you inherited it from a family member or whatnot, you can actually, you don't have to take a minimum required distribution on that account either. So just some neat things you could be thinking about. So if we can go on to the next slide, I want to change up a little bit and talk a little bit about the markets. So now Laurie did a great job talking about where the markets have been, and I'm going to hit those a little bit as well. And then I want to talk a little bit about the opportunity. So first off, this is a dated slide, even though it's as of the end of 2019. You can see that the market, I really want to show two different things. This is the S&P 500. I want to show the last two downturns, just kind of in a big picture standpoint. Remember the tech market, right? The tech bubble ended up being the bubble burst. The market from the high to the low is down 46.3%. Okay. Now, during the subprime crisis, remember the market went up again, then came back down, and that was in the year 2000. Late 07 going into early 09 was the high to the low, and that high to low was down 52.5%. And then the market did nothing but go straight up, right? And so on the next slide, I want to talk about, let's see how far it really went up. Let's now we'll switch gears and look at the Dow. And remember, the Dow is more the 30 industrial stocks that really are part of the stock exchange. They're supposed to be pretty representative of the overall stock market. Now, this is kind of neat. I really like this slide because what I've done is just captured the highs and the lows just to kind of give you a little perspective with numbers, right? So, and I put it according to a date. So if you look at October 9th of 07, the Dow is at a high of 14,164. Now, by the way, these are closing values. So it's what the Dow closed at that day. And then as of 3/9 of 2009, so it went from the high to the low was in March 9th, it went down to 6547. That was a major decrease, right? Then just a couple of months ago, the Dow went back up to an all-time high, and that all-time high was 29,551 points, okay? And then it went to a low. So its low in this last market was on the 23rd of March, okay? Again, not that long ago, went down to 18,591 points. And then currently, actually, this is as of 3:30, it went back up to about 22,000. It's right now kind of bobbling up if you look at it between 23,000 and 24,000. So I want you to think about this. And on this next slide, I just want to talk about a couple of different pieces of this, which is pretty interesting. So think about it this way. The Dow had never gone up for that long. It had almost, by the way, it had surpassed the 10-year period, but it almost went up to 11 years. Had it gone up until March 9th of this year, it would have gone up for 11 straight years. Now, again, do you know how many times it's done that? Never. It had never gone up for that long. And so that's an amazing point. We really didn't expect it, right? It had never gone up that high. It hit an all-time high of the 29,551 points, right? So interestingly enough, it never gone up that long, never gone up that high. As a matter of fact, most increases are usually 5 to 7 years. Typically, the market goes up 5 to 7 years, and something causes it to fall down. Goes up 5 to 7 more years, something causes it to fall down. This time it went up over 10 years, almost 11 years. So, and what's interesting, again, we work with people that are very close to retirement and retirement. So a lot of times people are thinking about this nest egg. They work 90,000 plus hours to put this money together, and they really want to enjoy it. And so they tend to get a little more emotional when they get close to that retirement time frame about this money that's now supposed to take care of them. Now, as I always say to people, hey, look, you've been working for years for your money, and in retirement, your money's got to work for you, right? So what the one thing I want you to remember, this was expected, okay? So this downturn, I've been speaking to it in our webinars and the seminars for the last probably 3 to 5 years. I said, hey, you know, the market is going to go down. What's your strategy? What's your plan? So it was going to go down. We knew it was going to go down. Everybody thought it was going to go down, but kind of everybody put it on the back burner, okay? Well, here's the reality. The reality is if you're in retirement or will be soon, you will experience 3 to 5 more of these downturns during your retirement. And so the point I make is if it's going to go down several times in your retirement, come up with a plan. If you can have a plan, and I'll show you a couple of different options for that, but if you can have a plan for what to do when it goes up and what to do when it goes down, I think you're going to be in a much better situation, okay? So again, there are different ways to do it, but I'm just encouraging you to be always, when you're thinking about upside, I want you to always have kind of a part of your brain saying, okay, what do I do on the downside? What do I do when it does go down? Because what I find, what's really interesting, again, I meet with literally, I've met with thousands of people in the last 30 years of doing this. And what I found, as the market does better and better and better, people will have more and more of a higher percentage of stock in their portfolio. So if they said, hey, you know, I'm a growth and income investor, I've got 60% stock, 40% bond. As the market does better, their stocks move up, but their bonds don't. right? Their bonds don't move up as quickly. So they end up going from maybe 60% stock, 40% bond to maybe 70 or 80 or even 90% stock, maybe only 10% bond. What that means is that when the market has that inevitable downfall, they're going to be hit pretty hard because the majority of their assets are stock. Okay, so again, you want to just be thinking about that. So let's move to the next slide, and let's talk about what you can actually do. So there's a couple different things, or a few different things, and some are more passive, and some are more active. So these first two things just want to talk more of a passive routine or passive role you can take, which means just how do I passively protect on the downside? Okay, well, one is you can hold a lot more cash, right? I mean, there's some textbooks written on this that say, you know what, if you held 1 to 2 years of cash on hand, you would never have to worry about a downturn, right? And that's kind of valid, but still, what that's assuming is that you're still okay watching your portfolio. You got enough cash to live off of. You don't need to take anything out of it. It's assuming you're okay watching your portfolio go down. A lot of people aren't okay with that. But again, it is a good passive strategy, and it can work. Again, what happens with the cash, though, it's not outpacing inflation and taxes because it's got to be available. It's got to be cash, okay? So the other thing is you could balance your portfolio a little bit differently. In other words, you could think, I'm going to be more conservative. I'm not going to be that, that person that went from a 60-40 split up to 90% stock. You can be the person that says, no, I'm a growth and income investor. I have 60% stock, 40% bond, but I'm going to rebalance to that. And I'm going to keep rebalancing to make sure it stays that way. Because the difference between a balanced portfolio like growth and income at 60-40 versus more of an aggressive portfolio like 90% stock in a downturn is significant. That 60 portfolio will not go down nearly as much as that 90% stock portfolio, right? And so, but again, it assumes that you're going to do rebalancing, right? Which it can be a very good idea to do that. So these two strategies, again, are just more passive strategies. If you follow them, you can systematize it with different kinds of holdings. You can systematize it by just having more cash on hand. There's a number of different ways to do it. If you want to use some kind of, and I don't even like to use the word hedging strategy, but let's say active strategy, it just takes a little more work, or it takes some help depending on how you view it. But at the end of the day, you can do a number of different things to protect on the downside. And so there are a number of different ways to do it. There's option strategies. You can buy into different product strategies that have downside protections built in within them. You can actually, there are different strategies or management strategies where you can actually manage your portfolio differently. So as the market goes down, you're not market timing more because it's a systematic approach. Market timing says, hey, I'm going to, as Laurie was saying, hey, I'm going to try and, figure out exactly when to get out and exactly when to get back in. That does not work. You don't want to do that. But if you had a systematic approach to how to get out of the market slowly as it's going down and get back into the market as it starts going up, that can be very, very, very efficient to your portfolio. And so, again, why do I say this? Because these things I've researched from time and time again, we've utilized them time and time again, and they work, right? But again, you can't kind of do a half and half. You need to be really thinking about this. Do I want to be more passive or do I want to be more active? And it's really up to you. So you do have options. My overall point in saying this is that if you do know that the market's going to tank or it's going to go down at some point pretty significantly, just have some kind of downside protection strategy built in. Again, whether it's more passive or more active, just having the system in place is the thing that's really going to save you. All right, so let's move on to the next page. So I want to talk about some of the things that you should be thinking kind of in the back of your head in some of the, let's say, overall planning you can do. Now, I am a planner without a doubt, but I'll give you a quick little story on why I am. You see, when I was in high school, we were a family of 5, and we were all, my brother and sister going to college. I was going to my junior year of high school. Well, it turned out my father had a heart condition that nobody knew about. And so my father passed away. Now, he was the breadwinner of the family. He was the one that really made the income that took care of all of us, paid for the house payment and all that. But at the end of the day, my mother now, who was a part-time travel agent, had to take over, right? Well, she didn't. She had a part-time travel agent, so she really wasn't the breadwinner. There was very little life insurance, and there wasn't any kind of plan. Now, back then, I was going into high school, so I didn't really realize how big of a deal that was. But over time, what happened was I started thinking, well, what could have helped them out? What could have helped my mother be better prepared for this? Because for the next 10 years, my mother and we as a family struggled. We all pitched in, we all worked, we had jobs that helped not only pay for our own schools, I went to a small Catholic school, I paid for that. paid for my college as well as my brother and sister did, and we helped my mother out just with the mortgage payments. She didn't know whether she was going to lose the house. But I thought about this. I said, what if they had a financial advisor and a financial plan? That financial plan, I think, would have set them up to make much better decisions going forward. And I bring that up because I truly believe everybody should have a financial plan. And just as Laurie said, have a plan, follow it, stick to it. The beauty about the plan is even if you're in a market like that, like we are today, it'll help you look at the situation to be able to say, okay, I know the market's going down. How does that look long term? How does that affect my overall planning? Am I still in a good position? It can also help you pre-experience this. So a lot of times when we'll do a financial plan for someone, we'll say, okay, what if the market really went down significantly? What would happen to you? What would happen to your portfolio? Could you still stay retired? And so that's a really good exercise, and that's what the financial plan does for you. So again, I really want you to be focusing on that because it just makes sense. If you can get a written plan and you can follow it, it's much better than not having a plan at all, because not only can you look at these adverse effects and what will happen, you can also look at, hey, how can I start to take advantage of things? What kinds of things can I do to do exactly what Warren Buffett said, is where I can be greedy while people are fearful. All right, so let's move on. Next slide, I just want to talk about a cash position. So it's funny, we either see people that have either a lot of cash or hardly any cash. Okay, so I want you to think what you really need. From a cash standpoint, you typically need, the average person needs about 3 to 6 months of living expenses, right? So what that's designed to do is handle any kind of emergency so that I don't necessarily have to go and take money out of my investments for an emergency situation, right? So 3 to 6 months works really well. Typically, you don't have emergencies that'll last, they'll take up more money than that would require, right? But you need to have it in a liquid account. Now, 3 to 6 months is not 3 to 6 years, which is what I see a lot of people having. I see literally people with $100,000, $200,000. I've seen someone before with $2 million sitting in cash, all right? The thing is, that cash is not doing a whole lot for you. You need to think about that as well. So again, just want to make sure that you've covered that. All right, a couple other things. Let's go to the next slide. The Roth conversion. This is a time when you want to start thinking about opportunities. And so if I can take money out of my IRA today and I can actually pay the tax today, I move it to my Roth, I will never have to pay tax on that again. So there's definitely a beauty in that. I want you to start thinking about how that works, because in a down market especially, so the Roth makes sense for a lot of people, but you need to do a calculation. That's where the financial plan comes in, because you can look at how much will it cost to do the Roth conversion, and then what's the overall benefit it's going to give me, okay? The other thing I like about doing a Roth, especially in a down market, is that if I do a Roth today, I'm able to do, even if let's say I was going to convert $10,000 out of my IRA to my Roth IRA, if I did it in January, I would convert less shares, right? And the same amount of money, but less shares. If I do it now when the market's down, I'm going to convert the same amount of money, but more shares, so when the market comes back up, I was able to take more out of my IRA and put it into my Roth IRA, and now the money in my Roth IRA is going to be tax-free. So again, it's an opportunity to think about that can really help you. And then let's talk about a couple last things. Let's talk about refinancing. Right now, rates are low. So let's go to the next slide. Refinancing really works well right now because rates are so low. But again, there's some rules of thumb to think about. Now, you're going to get a better rate if you refinance to a 15-year. Right? We have a lot of clients that have been refinancing to 15-year mortgages because they can get the rate a lot lower. And in some cases, it doesn't change the payment that much because they're refinancing when they're already 20 or 25 years in. And they can even do, you don't even have to do a 10-year, you can actually do a lower term than that. The rule of thumb, though, is if you have less than a $400,000 mortgage, you want to save at least 1%. Over a $400,000 mortgage, you have to save at least 0.5%. Again, these are just rules of thumb. You should really kind of plan it out, but they can make a lot of sense for you. All right, last couple slides before we wrap up is it's time to rebalance. When we talk to people about rebalancing their portfolios, one of the things we talk about, and one of the big issues is, hey, it's going to be a big tax bill. I don't know if I want to do it. Well, guess what? When the market's down, the tax bill is lower. So that's number one. Number two is you can really strategically rebalance right now. And the beauty about strategically rebalancing is that if you do it now, you can say, okay, I know that let's say my foreign stock got hit a lot more than my domestic stock. And I think that the foreign markets are having much more turmoil. I don't think they're going to come back as quick as domestic markets. You may want to strategically rebalance more into domestic assets because they'll rebound quicker. So you have a better return. So now's a good time to rebalance from a tax standpoint and also from a strategic investment standpoint. And then last thing is the big thing to think about is using some kind of specialist that you know can help you, that understands your situation. Kind of like I would give the heart surgery. If you were going in for heart surgery, you're not going to go to your general doctor. You're going to go to a specialist. You're going to go to not only a heart surgeon, but one that's done that procedure many, many times. Why? Because they know what's going on. They know how to do it. They've got the experience. Well, it's the same thing. I want you to think about your retirement investments, your investments in general, as the heart of your planning, the heart of your retirement. You want to make sure that's handled by someone that really knows where you are. Now, you might be able to do it yourself, which is fine, but if not, make sure you work with someone that knows what they're doing, that they're a specialist in that area. All right. I hope this was helpful. Let me wrap up by just going a quick summary. So in summary, look for and profit from the opportunities that are out there right now. And they are right in front of you, but you got to take advantage of them. Okay? Number two, make sure and don't only look at the downside, but look at the upside as well. But when you're looking at the upside, because a lot of people focus on that, make sure that you, in the back of your mind, you're thinking, okay, but if the market does go down, what am I going to do? Right? Have an emergency fund, start with that written plan, do a Roth conversion, refinance, and rebalance if it makes sense, and work with a specialist. All right, folks, thank you so much. I appreciate it. And Lindsay, looks like you're back on, and we are ready to go for some questions.
Very good. Thank you, Kelly. I think if Laurie's keyword was context, yours is probably balance. So audience members, we heard from some of you in advance, some questions that you had that you wanted to pose to our presenters. You can continue to submit questions on the chat function that's on the right side of your screen. Any questions that we're not able to respond to due to time today, we will include that in a written Q&A that we will publish and send to you next week. As a reminder, please indicate which panelist you want the question to be directed to, or both. So let's start with our first question. It is from Donna, and it is posed to Laurie. Markets usually respond to elections, and this is a big election year in the United States. What do you think will be the impact of the elections on the markets?
That's a really good question, and it's a question I've gotten a lot from clients, not just in this election, but in previous elections. And it won't surprise you to know that people have different feelings about, I had people say that the country would be ruined if Obama were elected president, the country would be ruined if Trump were elected president, and the market really doesn't care as much about politics as we do. We live in DC, it's a company town, I get that, but the market really in many ways doesn't care, particularly when you look at it over a longer term. And, again, if you think through history, there have been different times when things are just as out of balance as they are now, or things are just as, people are just as panic stricken. When Nixon and Humphrey ran against each other, that was Vietnam War and assassinations of leaders in the United States. Actually, you could take a look at Obama and McCain. That was, up till then, the worst recession since the 1930s. So markets will have short-term responses based on what they think will happen with, different legislation, et cetera. But the average return for presidential elections is still positive. It's positive. I think it's like 70% of the time there are positive returns in election years. So, I can't prognosticate on what's going to happen politically or what will happen with the market. I can assure you that it will move and it will respond to things that it sees in the news. But it's another example of something that's short term and that you don't want to plan your investments around what people think is going to happen in politics. God help us. That would really be difficult.
Thank you. This is a question from Trevor. It's posed to both, and we'll pose it to Kelly first. How do you think the markets would react if there were a resurgence of COVID-19 this summer or potentially in the fall, as some have predicted?
Yeah, that's a great question, Trevor. I've thought about that a lot, and again, that's where I do think you need to really be thinking on that downside protection standpoint, because they could do the exact same thing. They could hit all-time lows again. And again, why would that be? Well, because if you think kind of factually speaking what's going on, there are a lot of people that are not going to be getting paid. There are a lot of businesses that are going to continue to not make money and potentially go belly up and not come back. And there are a lot of even bigger businesses that are going to have some pretty major issues that we may see either go down significantly, or again, some of these businesses, look at some of the cruise lines, you may not see them come back, or they may restructure, or there may be a lot of restructuring within that industry. So I do think it could have a pretty significant impact. So I do, again, go back to what I was originally saying, is don't time the market, but have a plan B, have some kind of downside protection strategy built into what you're doing.
So we have 3 words: context, balance, plan. This is a question from Bob, and it's posed. Oh, excuse me. Wait a minute, Laurie. That was a question for both. I apologize. I didn't give you the chance to answer the question. Sorry,
I think
Trevor.
Kelly's answer was great. I think Kelly's answer was great and about covered it. I would say that the stock market is a leading indicator. So it's, not what's happening right now, but what it anticipates will happen. And so, I would keep that in mind. And as Kelly said, it's about earnings, it's about expectations, and it's about long-term expectations. So the market is trying to price in not what's happening right now, but what's going to happen a year from now. And we don't know what's going to happen next month. So that's why, again, we're talking about long-term. It's going to be tough on business if we have these resurgences, and tough on humans, kind of more than business, but businesses too. So yeah, I think there's reason to keep a watch on that and see how things go.
Thank you. This is a question from Bob. It's posed to Kelly. I have required minimum distributions going to 529 accounts for my grandkids. Is now a good time to do it, or should I wait until the market goes up?
Okay, so I guess I'd look at that a couple different ways. First of all, you're not required to take a required minimum distribution this year. So I may look at it, if you have other sources, I may look at taking it from another area. Probably wouldn't do it from the IRAs at this point, because you're causing more tax that you don't necessarily have to cause. Now, it depends on where the money's coming from. If you say, well, I got the money in cash and I'm putting the cash into the investment, makes a lot of sense to do it now because the market's down. If it's coming from another investment going into an investment, then you kind of got to look at it to be able to say, okay, but where is it coming from? Because if it's coming from fully invested and going back into a 529, which will be fully invested, then it's kind of a lateral move market-wise. But again, if you can take from cash and buy at a low in the market, I think it's going to help. Because again, and I'm sure Laurie would agree, when you think about where these markets, actually, Laurie, I'm sorry, I don't want to put words in your mouth though, but we all know that the market's going to come back. We don't know when, but it will come back. So if the 529 money needs to be used right away, then I probably wouldn't put it in the market. If it's going to be used 5, 10, 15 years down the road, for, let's say, young grandkids, absolutely, I think it's a great time.
Thank you. We now have a question from James. It's for both. And let's do Laurie first and then Kelly. What is the best money source for paying taxes on Roth conversions? This can be a rather large chunk of change. I did a conversion in 2019 and paid 32% in taxes, and that was an ouch factor.
Yeah, and that's another reason why you need to plan before you do that. Kelly talked about in his presentation why this is a great opportunity to do that, because you would pay, you're paying the tax on an amount that has decreased because the market's gone down. So it creates opportunities. But if you pay the tax out of the withdrawal, you actually mute the impact by quite a lot. So if you can plan to take the tax out of cash flow or out of other funds, that's where you would get the maximum benefit. But again, you should run those figures. Taking out this money and changing it to a Roth, is that going to put me in a different tax bracket? What kind of things can I expect to happen by making this change? Because it can be very beneficial, but you have to. It's different for every individual. You got to plan on how that might work for you.
Over to you, Kelly.
Yeah, and I'm definitely, Laurie, I'm a fan of everything you said, without a doubt. I'll go back and just reiterate the one thing, which is planning. Interestingly enough, the average person will do a Roth conversion without looking at both sides of the equation. How much does it cost and what's my ultimate benefit? By having a financial plan, you can look at both. You can say, oh, if I do that, it's going to cost me 32%, which means you may back off and say, oh, I don't want to pay 32%. But the other piece is, you may say, oh, it's going to cost me 32%, but here's the ultimate benefit that either I'm going to get later in my life or my kids are going to get. And so maybe that's worthwhile. So again, to me, I would do the plan first, because you want to determine, does it make sense long-term to do it? Because that'll help you, it'll really help you figure out what to do from a tax standpoint. And then again, I would not take out of IRA money to get the tax to be able to pay for the IRA or Roth conversion. Definitely add a cash flow or cash position. And again, don't think you need to do a Roth conversion. It's not for everybody. Everybody should be reviewing it, but it's not for everybody.
Thank you both. You have been tremendous in terms of the sharing of your generosity and your knowledge. We've got some key takeaways around historical context, balance, plan, think long-term. Am I missing any of the key themes that I heard you all communicate? If you're going to put it in 2 or 3 words, Laurie, you go first, and then Kelly, just 2 or 3 words that are your key takeaways for the audience today.
Yeah, I think you basically got it. Context, long-term planning.
Kelly?
Yeah, the only thing I'd add is make sure you have a plan to capture the upside, but to protect on the downside. Just have a plan.
Thank you both so very much. We're grateful that you have shared your expertise and your time with our listening audience. Now, in the meanwhile, for benefit of our listening audience, we are going to be offering future webinars. By completing that survey I mentioned, you will help inform the topics that we will select. So I want you to stay tuned to emails, print information from Goodwin House about upcoming webinars. I also want to refer you to this slide that you see in front of you. This is what it looks like when you visit the Goodwin House website. And you'll see that across the top, there is a yellow navigation bar, and that connects you to our COVID-19 resource page. And when you go to that page, you're going to see a lot of resources. First, you're going to see statements and updates about Goodwin House and our efforts to keep our residents, our members, and our staff safe. So that is there. We update it constantly. Then you're going to see a listing of different resources for older adults. How to stay active, socially connected when you're at home. How to stay emotionally calm during this time. You'll also see websites for local health departments. They have guidance as well for older adults. So we encourage you to visit our website and use it as a place of information and resource. As you think about the next few days, as you think about the next few weeks, as you think about time leading up to June 10 and beyond, we want to leave you with something that is a gift from our neighbors across the pond. You remember what was their mantra, the British mantra during World War II. We've adapted that a little bit to say, keep calm, stay home, and do stay well. That is our wish for all of you. So I want to say to our listening and viewing audience, thank you so much for joining and submitting your questions today and being part of this effort. As previously noted, we will be sending a recording to you of today's webinar and a written summary of the questions and answers that were posed to Kelly and to Laurie. Now, before you leave the webinar, if you would just take a few minutes to complete the short survey, it's going to pop up 2 screens from now, and the survey will take just about 2 minutes for you to complete. We send all of you our very best wishes for your physical, your emotional, and your financial health. Thank you, and that concludes today's webinar from Goodwin House.